Hi everybody, this is Neeraj here. I'm going to be talking about how to take swing trades using a bull flag pattern. I've gone through the various charts in the NEC 500 and I came up with three stocks that I would just like to share with you on how we could have taken an entry here on the bull flag pattern. So what is a bull flag pattern? A bull flag pattern basically is a pattern where uh, price rises up as if it's a flagpole, and then you have price consolidating, and then the price moves upward. So, couple of things here. Price should be in an uptrend since we are going to go long in a swing trade, and then the price should consolidate, and then when the price finally breaks out of the pattern, we take an entry for a target of approximately the length of the pole. So you see Abbott India here. I'm going to use a trend line here just to show you. For example, this is our flagpole, and I'm going to make a flag here. This is our flag. I'll keep it at the low here. So this is the pole, this is the flag. What happens is price has gone up without taking a pause. Then price consolidates here. So it looks like a flag. Couple of things. Price should be in uptrend. Uh, you see here rising volumes when the pole is being formed, and then you will have low volumes here. Price is consolidating, and then the price finally breaks out. Now, what happens here is that there are buyers who have gone long here, and some have come in at the start, some have come in the middle, and they decide that now maybe we need to book profit. They look at this green candle and they basically say, let's look at the RSI here. It's 80. So as per conventional knowledge, 70 is oversold. Overbought, and they think that there's going to be profit booking, so why not book profit? So they'll start booking some profit. But then there is smart money and other buyers who missed out all this action and are eager to get in on the trade. So they will basically either start buying here. That is why the price doesn't fall further. And some will wait. Some momentum traders like us will wait for a breakout of the bull flag pattern and will enter when this flag pattern is broken. So what we can do here is we will take an entry here on the break of this flag pattern. This is the high. So I'll keep basically long entry, and we'll take a long entry here at 26332.35 is the high. I'm sorry, it's 26249. So let's say we take an entry at 26550. Just let me check again. 26250. So make it 250.50. We add a bit of buffer so that our order gets pulled in, and we'll make this green, and we'll keep our stop loss at the low of the flag. So let me copy this here, keep it here. This will be at 28 24,832. So let's make it 24,830. 24,830. Text, you can type stop loss make it red. So you have 24,830 as your SL. You have your entry. If you and what is going to be your target? We've decided the entry. We've decided the stop loss. Now the length of the pole basically is going to give you your target as well. So from here, getting 10.75, and you take it from your entry. And you would have gotten out here if you kept this as your fixed target. Price went up, came down, but then it went up again. Let me bring it here so that there is no overlap of the candle. Otherwise, it's going to create confusion for you people. Yeah. So you would have gotten out basically here if you decided that this was your fixed target, or if you trailed it, then you will continue to be in the trade. Now, the stop loss basically 24,830 and 26 is like almost a 1,400 rupee stop loss. So if you decide that no, this is too much for me, I can't bear such a loss, you could keep it halfway in the flag. Your choice. There's no right or wrong. The benefit here is that your position size will increase and your risk reward ratio will also increase because your stop loss is small. But the drawback here is the price could swing into the flag for a bit and then continue in your direction, and then it leaves you regretful having missed out on the big move. So it's up to you. It's totally something up to you. There's no right or wrong here. Based on the number of trades that you take on this pattern, you will slowly realize that what is the best place to keep a stop loss for you. So I'll reiterate, a bull flag pattern basically is where the price has gone up like a pole. The pole may be straight at times, it may be sideways, it may even be tilt uh, to the right. But under no circumstances should the flag portion be equal to the length of the pole. Because if the price kept going right up to here, then that's not a flag and pole, right? You've seen our flag, right? Any flag. So flag is smaller compared to the pole. It has to be in an uptrend because we are talking about a bull flag here. There's increasing volume here, there's decreasing volume and consolidation here, and then finally a breakout. You see this big candle. Although this is a breakout, it broke up, but then it came down. It pierced the flag, but still managed to close above this red candle. And then you see that big momentum thing, and then again price takes a breather here. So this is for Abbott India. This is how you trade a bull flag pattern. I'll go to Amber. In Amber, like I was mentioning earlier, you have slightly tilted pole. So this is your pole. This is your flag. Okay. So this is your pole. This is your flag. Your entry would be anything above this point. So let me mark the entry here. Entry would be above the 3840, so it will be something like 3845 or something. 3840, so it will be something like, you can mark this as green. You can keep 3842. You can keep it 3841, up to you. You write something like long so that when you revisit this chart on your mobile, if you're working somewhere, you'll come to know where's your entry and where is your stop loss. So we enter here at 3842, which is outside the flag. and your stop loss will be below the flag pattern. So although the lows are contained in the flag, in the center of the flag, you basically keep it somewhere here. You can decide the price, give or take a few rupees here and there, make it red, SL. This is your stop loss. Or like I already explained earlier, you could have kept it in the center here. Now, your target is again, your target is again, it's showing a target of 25%. So, copy this here and it will be, target will be here from the long. Now, in this case, what we find is, you see the pole, you've got the flag, you have volumes here, then you have consolidation with low volume, then you have a push here. If you see here, you have a push here, and then you have rising volume. Now, if you waited for the fixed target here, you didn't achieve it. Let me bring it here. Yeah, you just missed it, I guess. Uh, and if you didn't sell here, price has gone down and it's hit your stop loss. Now, it's hit your stop loss if you have kept it in the system. If you didn't keep it in the system, then and if you're going to sell every morning based on close rates, if you keep stop loss with yourself and not in the system, then you would still be in the trade. The drawback here is this spike could have gone right up to here and then it has closed. So if you didn't maintain in the system, you're cool. But if it has gone down here and it closed here, if it closed here instead of going up with buying pressure, you would be in a more bigger loss than your loss that you decided before you took entry. So it's up to you whether you want to keep your stop loss in the system. That if you keep your stop loss in the system, the benefit here is basically that you will have a limited stop loss, but intraday volatility can take you out. But if there is a really big bearish candle, it saves you from a huge stop loss if you're in the system, and vice versa. Now, if you didn't trail your profits here, you would have been out of the trade. If you waited for this, didn't move your stop loss, didn't trail, you would have lost out here, not made any money. Up to you whether you want to trail, don't trail, keep your stop loss here below the flag pattern or in the center. Uh, totally up to you. If you look here in Abbott India, we got our profit target, and price is still continuing upwards. Now, here also you could keep trailing and be in the trade, or just get out at a fixed stop loss, not having moved your stop loss, get out of the fixed target, or again trail. This is such a big candle. You could have moved your stop loss from here to the low of this candle, and then you could have moved your stop loss again to the low of this candle. Up to you how you want to do it. And if the price has gone up and you're still in the trade, you could move it either below the swing low, or you could keep it at a 3-day low and a few 50 paisa here and there, or a buck here and there. Up to you how you want to trail. So we saw Abbott India bull flag pattern. We achieved our fixed target in amber. Assuming we didn't trail, we didn't make any money, we lost our this thing. Let's go to Cochin Shipyard. Cochin Shipyard, you have a big flag, and this is just like an exact pole, just like we see when we hoist our flags. I'm going to keep it here. I'm going to keep a trend line here. Okay. And I'm going to get the flags using a parallel channel. So see, this flag pattern is very, very tight. The tighter the flag and the shorter the consolidation, the better it's supposed to be theoretically. Theoretically. Again, you see, we have a huge spike in volume. We've got a volume of 22 million compared to the 20-day volume of 6. So almost 3.54, almost 4 times. Then you have low volumes here, and then again a breakout. It's a breakout. Basically, it's a gap up opening and a huge candle. Again, a volume of at least 3 times, almost bordering on 4 times. Now, where do we take entry here? Again, I think by now it should be clear. You guys can tell me. Now, you guys are experts in trading a bull flag. So, the entry will be, since this close appears to be within the flag, we are going to take an entry. You can take an entry here. Since we have a spike, you can take an entry above the high just to be safe. See, the closure is 789, the high is 805. You can take an entry here just outside the flag pattern, or you can choose to go above the spike uh, to be on the safer side to avoid the volatility at the start of the day. It's better that you take it at 806. So, a few rupees here and there won't matter. It's better to be safe than sorry. So, I'm going to take a horizontal ray here and put my entry at 806. Keeping a buffer so that my order gets filled in. I'm going long. It's green. Stop loss will be at below center, below the bull flag, say in the center, something, which makes common sense. There are 3, 4 candles here. So I have come here. Again, this low is lower than the lowest part of the red candle that you see here. Okay. But still, now you have 727.75. Low here is 747, right? So make this stop loss. Style will be red. Okay. Now you entered on the break here. Price went up, consolidated, spiked again. It's testing. This has become a support area. And one candle, two candle, three candle, and then you have another candle. EMA 20 is supporting that. There's another candle that's managed to breach EMA 20. Uh, it's closed at 839, whereas EMA 20 is 845.31. But you're still in the trade. Your stop loss is still at the place there is. So we are still in the trade. Now, I've just given you 3 examples. Bull flag pattern. And if you see here, the price is in a continuous uptrend, slow but steady, slow consolidation going up bits and pieces, bits and pieces. EMA 20 has been supporting it. So when you get in here, it's not a big stretch of the imagination. This is not a gamble. This is a calculated trade where you see a huge spike, 22 mil instead of 6 mil. You have consolidation. You didn't get in here. You couldn't get a chance to go. You were probably at work or you didn't get in. The action was too fast for you. Anyway, you waited and you happened to see this chart of when the bull flag was forming. You made this bull flag and you waited for a breakout. And when you got your breakout, you went in and you are still in the trade. Your SL is here, your stop loss is here. So basically, I'll just like to reiterate, bull flag is a good continuation pattern. It has a good accuracy rate, but please backtest it. You need to backtest this before entering or going for a trade in the long market, before taking a swing trade. But by and large, this is quite an accurate figure. You have a bull flag or a double top or a triple top. These are basically reliable, or a head and shoulder. These are by and large reliable patterns, but there are no guarantees in the stock market. All it takes is one trader to basically invalidate your trade. Big money comes in, and even the best patterns can fail. So that's fine. Over a period of trade, the every trade will not be and should not will not be successful, may not be successful. But over a period of time, if you're using proper chart patterns, proper price action analysis, you will 110% make profit. There is no way that you are going to make a loss, but in the long run. So basically, bull flag is marked by a pole and a flag where price consolidates with low volumes and then it breaks out. And this is how price behaves. Price doesn't go up. Like, for example, if a person is trying to walk up or climb up the Himalayas, he cannot do it without resting. He cannot just keep running or jogging up, or even for, on a steep inclined mountain, if you're a runner, you cannot keep running. You'll have to pause, hold your breath. Otherwise, you'll have a heart attack. Similarly, price takes a breather, then moves forward. Price takes a breather. See here, price has gone up, taken a breather. uh, Sellers tried to bring it down, but they couldn't. You see, this is hanging man sort of candle, hammer candle, and buyers resisted. So buyers are active. They Bears again tried to bring it down, but then you have support here. See the spike below. See the spike here. Then you have a good bullish candle where your open and low is the same. Then you have a gap up opening. But then again, bears are trying. See, bears are bears. They'll do what they do. They want to bring you down, and bulls will be bulls. They'll put their horns in and throw you up in the air. So, since we are in the long trade, we love bulls. Were we in a short trade, we would have said we love bears. We love all animals basically. We are an animal loving country, animal loving people. So this is all I had. If you like my video, if you have any questions, comments, please write them. I'm going to post this video on YouTube. Please like, subscribe my channel, forward it to others who are serious about trading, and continue learning, and let's make a lot of money. Thank you all. Bye. I'll see you in the next video.